In about 13 minutes, we will have the release of the UK preliminary GDP quarter-on-quarter and year-on-year data. British preliminary GDP is actually one of the most important economic releases, which is published each quarter. GDP measures production and growth of the economy and is considered by analysts as one of the most important indicators of economic activity. So what we can see here is the forecast according to a survey conducted by Bloomberg, as well as the previous data. And right here we have the chart of how the indicator has been developing during the past 12 months. What we can say that the crowd looking for official confirmation of British economy is as strong as it actually appears, based on a run of rather good economic numbers that we have seen lately. Today's first estimate of fourth quarter-on-quarter from the government is expected to satisfy, and as mentioned, the economists do predict an increase of 0.7% from last year's final quarter versus the previous 3-month period. That's also the current estimate from the National Institute of Economic and Social Research. What's behind the growth? The United Kingdom has been buoyant by easier credit conditions and increased confidence, the International Monetary Fund said in last week's update on the world's economic outlook. Let's have a look at some of the forecasts. There we go. So here we can see some of the 39 economists that were surveyed by Bloomberg with regards to the economic data. So we can see that the average estimate is 0.7, highest being 1%, while the lowest being 0.3%. Critical Recall says we have maintained our expectations for UK GDP growth at 0.8% quarter-on-quarter and 2.8% year-on-year after a similar pace of growth in quarter 2 and quarter 3. In addition, we have, actually quote Mark Carney, the Bank of England governor, seems to be downplaying the potential for upside surprises. He spoke at the World Economic Forum in Davos last week and said, as good as the numbers have been in the past 3 quarters in the United Kingdom, we're talking about 3 quarters of household-led growth, an economy that's running 20% below pre-crisis trends, that has substantial spare capacity, that has not yet rebounded, and that faces significant headwinds from its major trading partner from over-monetary conditions. In simple words, what it actually means to us mere mortals, today's GDP data would have to be unusually strong to move the Bank of England to change its current policy of keeping interest rates unchanged for the foreseeable future. And finally, we can also have a look at what are some of the Dukascopy community traders think about the impact of the UK preliminary GDP year on year. According to them, the impact will be 44% believe that the impact will be bullish, or 20 people, while 25 believe it will be bearish, 56%. Some of the comments that support their view, well, Daddy Pappy says growth momentum is expected to have continued in the last quarter of 2014. Comments from the Bank of England minutes releases recently point to increased optimism based on survey, including the PMI. In contrast to that view, we have Voltrad, who says, I believe the data for fourth quarter leaves with the limits of the forecast of 0.7%. It will be less than in third quarter, and GDP hence means downwards. So these are just some of the fundamentals that we wanted to share with you. And now to move on forward, let me welcome my colleague Thomas, who is going to have a look at the potential negative impact of the upcoming data release on the Great Britain pound.
Hi everyone, you're having a good day. So today I'll be presenting a possible trading strategy in case the GDP numbers came out worse than expected. And for that, I chose Great Britain pound, United States dollar, and you should see shortly my screen sharing of its 1-minute chart, which you can see right over here. Okay, my platform is a little bit stuck. So anyway, but what you're seeing is Great Britain pound, United States dollar 1-minute chart, and apparently we're having a small minor rally which went a little bit sideways in comparison to the predicted trading strategy. Let me just put this slide and figure this out on the spot. So first of all, why I chose Great Britain pound? Because current market sentiment is strongly bearish. So in case the data comes out worse than expected, Great Britain pound should lose the ground against the United States dollar. So the current market sentiment, which is bearish at 70% of traders holding short positions. In addition to this, 59% of all of the pending orders in 100 pip range around the current market price are also set to go short. Besides that, there is a very important factor of the overall attitude by the traders towards the Great Britain pound and United States dollar. Let's just try to put the slide on the whiteboard. It doesn't really want to appear apparently. So in addition to this, Great Britain pound is actually sold in 63% of the cases, whereas United States dollar is bought in 61% of the cases. So what else? Oh yeah, so also market sentiment of other market participants given by Oanda is 72% of their traders are bearish. Saxo Bank says that 73% of their traders is bearish. Daily Effects shows that 80% of their clients are bearish on the pair. So we have rather unanimous attitude across the market. Now, just to go with the numbers, initial idea was that our pattern recognition tool recognized as very small minor falling wedge pattern right over here on a 1 minute chart. There was reasonable to assume that it would continue to develop like this, but as you can see during the start of the presentation, we saw a minor rally which pushed the pair a little bit higher. Therefore some of the numbers doesn't really fit in. So anyways, I guess it will be rather reasonable to look at the daily low at 1.6579 right over here, which is 30 pips below the current market price as a medium term target for a take profit. So that stays the same, but stop loss most likely should be striked out now, and most likely should be substituted with the, I would say, 200 bar simple moving average, which we're seeing right over here at 1.66077, which is rather reasonable level, and at the moment it is 6 pips above the current market price. Now, if we quickly look at the technicals, where is the slide? So yeah, if we quickly look at the technicals, we can see that in the most relevant horizons, we do not see any major turning points. However, the trending indicators point at further appreciation of the pair, which is, in my opinion, taking into account recent development, is a little bit off the real situation in the market. So yeah, just to summarize, negative surprise trading strategy on Great Britain pound United States dollar. So sell at market, take profit set at the daily low at 1.6579, which would be currently 24 pips below the current market price. Initial stop loss, if the pair remains right over here, could be at the major level at 1.6600. However, if the pair dips above it, the stop loss could be set at the 200 bar simple moving average at 1.66075. I guess that will be all from my side, and 2.5 minutes left till the release of the data. I give the floor back to you, not back to you, but to my colleague Alexander.
Hello everyone. So thank you, Thomas. Just 3 minutes left before the news release. Once again, we are discussing UK GDP data, and even though Gita said that the quarter data is likely to show economic slowdown to 0.7%, if we'll have a look at annual growth, then it's likely to pick up significantly, and the figure should be around 2.7 or 8% compared to just 1.9% a quarter earlier. Therefore, the pound has a great opportunity to appreciate, and the positive surprise trading strategy will be based on Great British Pound and Swiss franc. As you can see from the chart on before our chart, the pair has been trading in boundaries of the rising wedge pattern since December 19th, and just last week, on Friday to be more precise, the pair penetrated the lower boundary. However, after touching 200 period SMA, the pair bounced back and currently is still trading in pattern's boundaries. Therefore, the potential stop loss could be placed around pattern support and the weekly pivot, right at the level of 148.74. So here it is. And the potential take profit can be placed at 149.77. That will be daily resistance and the recent high. However, I guess that will be too optimistic. An alternative take profit can be placed at 149.50, right at the 4-hour resistance. So as you can see, the pair just lost some pips just a couple of minutes ago. Yeah, but nevertheless, the market sentiment is currently bullish, with 56% of open positions being long. Attitude towards the pound is strongly bearish, as the currency is sold in 63% of all cases, while the Swiss franc is sold in 72%. So I see that the data is already out, and actually it came fully in line with analyst forecast. Therefore, market reaction was quite modest. So yeah, and actually we are seeing a pretty impressive downside rally on the cable, and the pair actually even touched the 165.50 level and obviously penetrated the potential take profit. Yes, so what else I can say? Pretty impressive rally. Once again, to be more precise, that will be around 45 pips movement, and the pair even almost reached a weekly pivot at 165.45. Yep. And once again, we're having a look at Great British Pound and Swiss franc currency pair. The pair just touched the potential stop loss at 148.74. However, further depreciation is unlikely, keeping in mind a bunch of support levels right at this level. So I guess that will be pretty much from my side. Hope that was useful for some of you, and I'm giving the floor back to Gita.
Thanks, Alex. Thanks, Thomas, for your technical analysis. But that is the end of today's economic data release. So thank you all for tuning in and joining us. And be sure to tune in to our today's 12 GMT webinar brought to you by the Dukascopy research team. Thanks again, and see you later on. Bye-bye.